California's 2025 housing collapse, faster, deeper, and more painful than expected. California's real estate crash in 2025 is unraveling at an alarming pace, much quicker and harsher than anyone had anticipated. While the statewide median home price is still floating above $750,000, buyers have largely vanished. Meanwhile, housing inventory has surged by more than 60% in several areas. Monthly mortgage costs now exceed $6,500 in many regions, but local wages haven't kept up, creating an affordability gap that's pushing people out of the market. Foreclosures are climbing fast, up between 30% and 45% year over year, and homes that once sold within days are now sitting unsold for over 2 months, often with steep price drops. California's booming suburbs are starting to resemble ghost towns, and the optimism of yesterday is becoming today's biggest regret. Number 10, Mission Viejo, from prestige to panic. Once a hallmark of affluent suburban living in Orange County, Mission Viejo is now showing troubling signs in 2025. With home values soaring to a median price of around $1.24 million, the city saw an 83% increase since 2020, but that growth may have gone too far. Listings have surged by 38% year over year, while buyer activity has dropped more than 27%. Homes that used to sell in under 2 weeks now sit on the market for over 45 days, a clear signal that demand is cooling fast. Affordability has become the city's greatest weakness. While the median household income is approximately $117,000, a 20% down mortgage at a 6.7% rate results in monthly payments around $7,100, eating up over 70% of a family's income. Young buyers are priced out, and even longtime residents are eyeing cheaper areas like Menifee or Murrieta. Nearly 1 in 5 homes listed have slashed prices. Foreclosure activity is up 19% compared to late 2024, a concerning shift for a city that had previously weathered downturns well. Retail centers like the shops at Mission Viejo are showing signs of strain too, with rising vacancy rates and a 12% increase in restaurant closures. Making things worse, the city's population has dipped 2.1% since 2022, while school enrollments have dropped more than 5%, hinting at fewer families settling here. If current patterns continue, Mission Viejo could become Orange County's first major post-pandemic housing casualty. Number 9, Costa Mesa, the cooldown hits creative core. Known for its creative energy and prime location, Costa Mesa is now grappling with the fallout of an overheated market. As of early 2025, the median home price has skyrocketed to $1.38 million, nearly 95% higher than 2019 levels. However, that momentum has reversed sharply. Housing inventory has jumped 41% year over year, and the average time on the market has more than doubled, from 19 days to 52 days. Affordability here is in crisis. With a median income of just $113,000, buyers are now staring down monthly mortgage payments of $7,800 or more, consuming nearly all their income. This cost burden has driven out young professionals, artists, and tech workers who once gave Costa Mesa its pulse. Rents aren't providing relief either, now averaging around $3,450 per month. As a result, the city has seen a 2.8% population decline over the past 2 years. Small businesses are suffering too. Retail vacancies have doubled since 2023, and commercial lease rates have dropped 17%. Even cultural staples like the Lab and the Camp are seeing less traffic, with boutique shops and indie restaurants shutting down. Office vacancy is also rising, up 26%, driven by remote work trends and businesses leaving the area. What was once a vibrant hub is beginning to feel hollow. Costa Mesa, once Orange County's lively creative hub, is now grinding to a halt under the weight of rising property taxes, skyrocketing insurance premiums, and unpredictable mortgage rates, currently hovering around 6.6%. Even longtime homeowners are starting to look for exits. If the current trends hold, Costa Mesa may shift from an artistic epicenter to a sobering lesson in what happens when real estate growth outpaces economic reality. The energy is fading, and some fear the soul of the city may be next. Number 8, Aliso Viejo, suburban dream on the edge. Tucked in the hills of South Orange County, Aliso Viejo was once the poster child for modern suburban life. But in 2025, that dream is cracking. Median home prices have climbed to $1.02 million, nearly 88% above typical levels for comparable Southern California towns. But what shot up quickly is now stumbling hard. Listings have surged by 45%, and homes now sit for 56 days, up from just 14 days 2 years ago. With a median household income of $112,000, most buyers simply can't swing monthly mortgage payments exceeding $6,400, and that's before taxes and insurance. Population is falling fast, down 2.3% in just 18 months. Even rentals are struggling, with landlords offering 1-month free deals just to fill vacancies. Office parks are thinning out too. Commercial vacancies are up 21%, and once busy shopping centers are going quiet. Big retailers are reconsidering leases. And behind the scenes, a 31% rise in foreclosures in just the first quarter of 2025. Homeowners who bought at the 2021 to 2022 peak are now underwater, and some are walking away. Aliso Viejo streets may look clean and calm, but the silence now feels uneasy. Beneath the surface, the foundation is beginning to shake. Number 7, San Clemente, Ocean Views, Market Blues. San Clemente has long been a coastal jewel, Spanish architecture, blufftop mansions, and surfing paradise. But in 2025, the luxury housing market is in serious decline. The median home price? A jaw-dropping $1.72 million, that's more than double its long-term average. But now, buyers are scarce. With mortgage rates at 6.7%, a typical 30-year loan translates into $9,800 a month, a number far out of reach for the city's $118,000 median household income. That's left only the top 10% financially able to consider buying. Listings have jumped 49%, and 40% of those homes have already had price cuts. Rents are also slipping, down 5.2% in occupancy, with average 2 bedrooms going for $3,750 a month. Population is shrinking to 1.9% net loss since 2023. The remote workers and out-of-town buyers that once drove demand? They're heading inland. Even tourism isn't saving the day. Boutique hotels are struggling, and beachfront businesses are closing due to falling foot traffic. Downtown sales are down 16%, and the charm is starting to fade. San Clemente's natural beauty remains, but beauty alone doesn't pay the bills. Unless a market correction arrives fast, this dreamy seaside escape risks becoming an oceanfront ghost town. Number 6, Tustin, the hidden gateway on the brink. Nestled between Irvine and Santa Ana, Tustin has long served as the more affordable doorway into Orange County. But in 2025, even this once accessible enclave is now unraveling under extreme financial pressure. The median home price has soared to $1.21 million, an 87% jump since 2019. Yet median household income hovers around just $115,000, a brutal mismatch. With mortgage rates holding steady at 6.7%, a typical monthly mortgage bill now tops $7,000. That gap is pushing buyers out fast. Listings have exploded by 42% year over year, and the average time a home sits unsold? 54 days, triple what it was during the 2021 frenzy. Nearly 35% of homes are slashing prices. Some sellers have even pulled their listings altogether, unwilling to accept lowball offers. Rentals are struggling too. Vacancy rates have jumped from 4.5% to 7.1%, and rents have flattened at $3,300 per month. Tustin's small business core is shrinking. Commercial vacancies are up 22%, and local retailers are getting squeezed by lower foot traffic and rising costs. The city's once strong pull for remote workers and young professionals is weakening. Population is down 2.4%, and foreclosure filings have surged by 28%. Especially among homeowners stuck with adjustable-rate mortgages from the 2021 buying frenzy. Tustin still offers charm and historic neighborhoods, but financial pressure is building fast. Without a sharp turnaround, it risks drifting into real estate stagnation, with vacant homes, shuttered shops, and a shrinking population. Number 5, Modesto, the Central Valley mirage fades. Once seen as a safe haven for Bay Area escapees, Modesto is now facing a sharp reversal. By mid-2025, the median home price sits at $410,000, down 11% from its 2022 peak. That dip might seem small, but pair it with a 52% surge in listings, and you have a clear case of oversupply. Buyers are vanishing, especially with mortgage rates near 6.8% and average monthly payments exceeding $2,800, a huge burden in a city where median household income is just $66,000. The pandemic boom turned Modesto into a hotspot for remote workers and real estate investors. But now, the tide has turned. Rents have stagnated at $1,800 per month, population is down 1.7%, and the foreclosure wave is growing, up 34% year over year. The situation is worse for those who entered with low down payments. 13% of all mortgages are now underwater, and delinquencies are rising fast, especially in neighborhoods east of McHenry Avenue and south of downtown. Commercial spaces tell the same story. Retail vacancies are above 18%, and layoffs in warehousing and service jobs have pushed unemployment to 6.4%. Well above the national average. Modesto's image as an affordable alternative is fading. With falling prices, flat wages, and evaporating demand, the city is now one of California's most vulnerable markets heading into late 2025. Number 4, Riverside, Inland Empire's boom on the brink. Riverside, the heart of the Inland Empire, once offered hope for families priced out of the coast. But in 2025, that dream is beginning to collapse. The median home price now sits at $565,000, a 68% increase since 2018. Yet cracks are now showing. Riverside was once the crown jewel of the Inland Empire, a growing city promising space, affordability, and opportunity. But in 2025, the shine is rapidly fading. Mortgage rates hovering above 6.6% have pushed monthly payments beyond $3,800 for a median-priced home, while local incomes lag far behind at just $74,000. That brutal math has sidelined buyers in droves. Active listings are up 47% compared to last year, and homes now sit on the market for 59 days, nearly triple the time it took 2 years ago. Nearly a third of homes have slashed prices, and desperate sellers are offering incentives like rate buydowns and covering closing costs. Worse, foreclosures are up 39%, particularly among FHA loan holders who entered the market with little equity during the 2021 to 2022 boom. These homeowners now face mounting payments they simply can't afford. The rental scene isn't much better. With average rents at $2,650 and vacancies on the rise, landlords are scrambling for tenants. At the same time, Riverside's economic engine is sputtering. Warehousing and logistics, once a powerhouse, have been hit by reduced demand and job cuts. Unemployment has crept up to 5.9%, and commercial districts are suffering. Retail vacancies have jumped 14%, and aging strip malls sit half empty. Once seen as a symbol of inland success, Riverside is now at risk of becoming another post-boom cautionary tale where homes sit empty, equity evaporates, and hope gives way to uncertainty. Number 3, Bakersfield, the boomtown that burned too fast. Dubbed California's energy capital, Bakersfield boomed during the pandemic, drawing remote workers and bargain seekers in droves. But in 2025, that growth is reversing hard. The median home price has fallen to $390,000, down from $440,000 in late 2022, an 11% slide. Yet homes still aren't moving. Listings have exploded 58%, and the average time on market now sits at 61 days, twice what it was in 2023. With local incomes around $63,000, and mortgage rates near 6.9%, monthly payments over $2,600 are choking affordability. Many buyers from the 2020 to 2021 boom are now trying to sell, often at a loss. Foreclosures are up 41%, especially in newer developments on Bakersfield's west side. Underwater mortgages are making a comeback, and demand is drying up fast. The city's economy is also feeling the heat. Oil and agriculture are weakening, and warehousing layoffs have pushed unemployment to 7.1%, well above the national average. That has developers hitting the brakes and homeowners tightening their budgets. Renters aren't spared. Vacancies are rising, rents hover at $1,650 per month, and landlords are starting to offer discounts. Meanwhile, commercial real estate is suffering, with big box store closures and a 19% increase in vacant retail space. Once viewed as the Central Valley's rising star, Bakersfield now stands on shaky ground, with falling prices, rising job losses, and neighborhoods slowly going silent. Number 2, Stockton. History repeats itself. Stockton is no stranger to housing market collapse. After a devastating crash in municipal bankruptcy in 2012, the city had clawed its way back until now. In 2025, Stockton's market is once again in decline. The median home price has dropped to $420,000, down 12% from 2022. And that's just the beginning. Stockton's dark housing history is coming back to haunt it. After clawing its way back from bankruptcy and one of the worst foreclosure crises in U.S. history, the city is once again in a downward spiral. In 2025, mortgage rates near 6.8% have pushed the monthly cost of a median home past $2,850, a heavy burden in a city where the average household income is just $62,000. That affordability gap is forcing buyers to the sidelines. Foreclosures are surging, up 38% year over year, and most are linked to buyers who jumped in during the pandemic frenzy at overinflated prices. The rental market isn't faring much better. Average rents hover at $1,750, but rising vacancy rates are forcing landlords to slash prices or toss in incentives just to keep tenants. Stockton's once surging population has declined by nearly 3%, as remote workers move back to major metros or leave California altogether. Meanwhile, unemployment has climbed to 6.8%, fueled by job losses in retail, logistics, and public services. Economic growth has stalled. Commercial projects are on hold, small businesses are shutting down, and some neighborhoods resemble ghost towns, half-built streets with rows of for sale signs and empty driveways. Despite years of recovery efforts, Stockton's 2025 crash feels all too familiar. Only this time, the warning lights are blinking earlier and brighter. Number 1, Irvine, the fall of California's shining star. Irvine has long been California's suburban poster child, clean, safe, and masterplanned to perfection. But in 2025, it's now the epicenter of the housing collapse. The median home price? A staggering $1.62 million. Combine that with mortgage rates nearing 6.9%, and the average monthly payment skyrockets past $10,000, pricing out even well-off professionals. And while Irvine boasts a high median income of $118,000, that's nowhere near enough to support the debt load of today's market. Inventory has exploded, up 63% in just 12 months, and homes now sit unsold for 66 days, compared to just 12 days during the boom. Nearly 40% of listings have dropped prices, and the once booming buyer pool has vanished. Foreign investment, a major driver of Irvine's growth, has dried up, thanks to tightening global economies and stricter lending rules. Rental markets are no escape either. Two-bedroom apartments average $3,950 per month, but vacancies are rising as renters flee inland or out of state. Population growth? Now flat. Net migration turned negative in 2023, and school enrollments are down over 4%. Meanwhile, office vacancies are climbing 22% and rising as commercial plants stall or fall apart entirely. Throw in sky-high HOA fees, soaring insurance costs, and brutal property taxes, and even longtime residents are starting to consider leaving. Foreclosures are creeping up, 31% higher than last year, especially in luxury developments where buyers stretched beyond their means. If current trends persist, Irvine may become a tragic example of what happens when even success becomes unsustainable. From California dream to housing nightmare, 2025 is rewriting the story.